So markets have had to deal with a lot over the last quarter. There is geopolitical risk that's rising as a result of tensions between obviously Russia and Europe and the US over the Ukraine boundaries. Other factors that the markets have had to deal with is very much around what is the extent that the Federal Reserve will take away stimulus from the marketplace. And the market has been coming to grips with exactly how that's going to play out over the course of the next 12 months. Europe, what's happening in China as well, whether or not the slowdown is going to be a little bit more severe than what we first anticipated. These are all factors that will basically play out for markets in terms of where are the earnings going to come from for equities, what is going to happen to interest rates, and the view in terms of what currency markets are going to do when you've got a variety of things happening. The way that we're approaching this is very much around the fact that we need to be prepared for a lot of the events that can happen that could actually look to upset market equilibrium. Australian investors are not immune from what's happening around the globe. As you are seeing that a lot of stimulus from central banks, particularly in the US, starts to come away, essentially that means that we're in a position that a lot of flows that have been driving into our markets from foreign investors are moving back into US dollar denominated assets. And that's why the US market has been so strong. But when you look around the world, particularly over the last quarter to 12 months even, emerging markets haven't participated in the sort of market rally that we've seen, particularly in the US. This is a result of China coming off the boil in terms of its growth rate. And essentially, what does that mean for a lot of other commodity-sensitive emerging markets? Now, Australia is not an emerging market, but very, very commodity-sensitive. And so the fact is that our mining boom that's sustained Australia over the course of the last few years is now in a position where we've really received all the dividends that we're going to get as a result of that. Now we need to find other areas that the Australian economy can actually start to really capitalise on that can replace the mining boom that we've experienced. One of the key events that's actually really got the market focus at the moment is what's happening in the Ukraine. Now, the Ukraine itself, there's about 45 to 50 million people that live there. It is not insignificant in terms of the population and its degree of growth. It's also positioned, obviously, right next to the Russian border and in Europe. So we're in a situation where one of the key things for the Ukraine, and particularly for Russia, is really understanding how the Ukraine is actually going to play out in terms of why do Russia want to actually get control of the Crimean Peninsula, and why does the rest of the Ukraine want to actually join the rest of Europe in terms of potentially becoming part of the Euro. Now, there is a real call between what is ethnicity and what is sovereignty. The Russians essentially have a call that they will protect their ethnic interests within the region. The Europeans respect sovereignty, and so they are respecting the borders and international law that's essentially that the Ukraine is one nation and you can't split it up. Both are coming from the same sense of ideology, really, and what we're seeing at the moment is whether or not that there is an underplay of activity where Russia wants to take a little bit more involvement in the Ukraine because it doesn't necessarily want to have a NATO country right on its border. Whether or not Russia become more aggressive in the way that they are going to, exercise control over the region, and whether or not the responses that basically NATO have put forward are going to be enough. The extrapolation of events that could happen is that the Russian economy could be severely impacted as a result of this. But at the same time, the Europeans are not going to be immune from this. And Germany is an export machine, and Russia is one of the main recipients of those exports. And so the way that this is going to play out is going to be imperative for particularly the European equity markets and how that plays out. We are more tied to the American market, and in general, sort of most equity markets are tied to that. But you've seen US equities really sort of drive higher, and I think investors' preferences at the moment are more for US dollar assets. As a result of that, they will buy US equities because interest rates are nothing to write home about. They are so low at the moment, you may as well just buy into equities. And particularly the S&P 500 in the US has had 22% per annum growth over the last 5 years. It's not really fundamentally driven. Like the US economy has had a very, very slow rebound in terms of its growth. But at the same time, companies have been able to generate earnings through cost cutting, and maybe that can continue to sort of hamper out. As quantitative easing particularly comes off, the market has to find a new degree of equilibrium. And always the transition from a particular scenario or an environment to another scenario driven by different factors, the transition in between, which is very much the year that we're in, is going to represent volatility at the same time. And we've seen that for the first quarter of 2014.